Welcome to the Closing Bell on the 23rd of April. There's a lot to talk about today. It's Friday here where when I'm actually recording this, so I don't know what happened Friday night in the US. But on Thursday night, we had quite an interesting day's trading. I'll show that to you in the charts in a minute. But if you have been watching these videos, you will know that I've been saying the US market is in a weekly downtrend. I'm expecting the rallies to be sold into, and that we're getting close to a point when the momentum can really shift back to the downside. And I think Thursday night's trading was a bit of an indication of that. We had Netflix coming out with a terrible update, their growth really reversing, and they plummeted 35% and still selling off. I'll show you that chart so you can get a sense of what's going on. The tech space in the US coming under pressure, US 10-year bonds really selling off now. I've been showing you that chart and we'll look at that in a second. That is the big piece of the jigsaw you need to understand as we go forward here. Our market, the ASX, going to all-time highs, but being rejected from that, and on the Friday down over 100 points as the US market turns down. So we have been outperforming the US market very obviously, but I don't know that we can hold up in the face of the US market really selling off. And I think the next step in these bonds is to watch a very important point, that 3.2% level in the US 10 years. Above there, I don't know what's going to happen, but it could get a little panicked, the selling, I think, in those bonds for a while, even if it's short term, but panicked selling in those US 10-year bonds will definitely see more downside in equities. So yes, very interesting times. Let's jump to the charts and see what is going on there. So here we have the US 10-year bond yield chart, and I'll just go over for you. When this chart is going down, that means the yield on those bonds is going down. You can see here, 9%, 8%. And when the yield on a bond is going down, the price is going up. So you can see here, when the yield on the bonds is going up, the price of those bonds is actually going down. So it's sort of the reverse of a normal chart that you'd look at, where the price is going up is good and the price going down is bad. In this one, if you own the bonds, the yield going down is good, the yield going up is bad for you. That's when the price of those things is going down. So at the moment, it's a quite strong sell-off that we're seeing in these bonds. I've been tracking this for you. And this is, a multi-decade chart. I just want you to note this very clear and strong downtrend, and to have the sense that this downtrend really is, a generation of asset prices going up. Because as those yields go down, it's much easier. People are borrowing money at low rates. They're able to buy houses at a higher price. Companies able to borrow money at lower rates, able to invest in projects that they otherwise wouldn't invest in, money being made, lots of people borrowing money, economy expanding. This is the story of our last generation, last 40 years. And over that whole time, we've never seen the highest low in those yields threatened, have we? This trend down in yields has been going on and on. And here we are, 3.2% is the highest level that rates got to in this last wave going up into 2018. So that's why I'm very interested in this level. And you can see, if we just go up close and look at this chart, that that 3% level was very important for a long time. So if I just look across at that 3% level, which is where we're at now, that was the high in rates back in around 2014. You can see there, it tried to get above there going into 2017, 2018. It nipped above there, and this is the false breaks that I always look for, where it looks like it's breaking out and then doesn't. So that topped out at 3.2% at that time, and that is really the highest rate that we've seen for, a decade in the US in those 10 years. And here we are with those rates now really screaming higher. This is the area where I've been saying over the last few weeks, this is where you'd want to see the buying step up in these bonds, because if you don't, watch out. And we haven't seen that buying step in yet. We know the foreign central banks and investors are not buying US bonds at the rate they have been. So that demand is actually lowering. We know the Fed is backing off from supporting the long end of the yield curve with printed money. So they are actually looking at shrinking their balance sheet, which means their current investments, your $9 trillion balance sheet for the Fed, rather than selling those bonds, they'll probably just allow those bonds to roll off as they mature. But you no longer have the Fed buying those bonds with printed money and the rest of the market front running the Fed and buying bonds with money, thinking, well, we're just front running the Fed. We know they're going to support the market, and we're making pretty easy money. So that whole game is ending. And really, where is the true price of these bonds? And this is what we're trying to find out. Inflation up at 8.5%, 10-year bonds at 3%. So you're still losing 5.5% to inflation each year. That is, if inflation sticks at 8.5%, which it probably won't. It'll come back off. But the story is that we need to find where does the buying really step in for these US 10 years. And there's lots of people who are long and wrong, who are currently sitting on losses, who are leveraged up into bond positions, such as the risk parity funds, who may need to sell, be forced sellers as they deleverage. And if stocks are selling off and bonds are selling off, that is when you can hit that panic button in some of those trading strategies. So this is the situation we're in, which is an interesting situation. Looking at the charts, this high from the last few years breaking out above there. My question is, what happens if it does just shoot through there? Now, you'd think that's a pretty low odds, but it's now higher odds than we've seen in a long time. And if the selling doesn't slow down, we break out above that 3.2% level, I mean, the selling could accelerate. You just don't know. Markets have a habit of doing things that no one expects. So this is the situation we're looking at as we see the US market start to look a little dodgy. So let's switch over to the S&P 500. So here is the S&P 500 futures chart, the weekly chart. We've been watching this one like a hawk as well. We know the weekly trend is now down. I've been saying that the buying we've seen over the last month or so was going to hit selling pressure. We've seen that. So there's a lot of boxes getting ticked here that the momentum is now shifting down again. And I just want to show you that we're nearing the point where the selling, again, could accelerate. So just pointing out for you the 10-period exponential moving average there and the 20-period simple moving average. They're the ones I look at just for the weekly trends, get a sense of what's going on. We had a multi-year rally with that weekly trend up. That weekly trend turned down in that first wave down at the start of this year. We saw the sell-off, which was quite a sharp sell-off, and then we saw a nice bounce. And I was telling you a while ago, I think around the sell zone of that wave is where the selling should come in. The high was exactly on the bottom of that sell zone. We've seen a weekly sell pivot a few weeks ago, which is when I was saying, watch out from here. We've then seen the first key bar down, which was last week. And that is when you get a weekly close below the low of the sell pivot candle. So that's just a sign of marching down slowly. The weekly selling pressure is there. And we've seen this week an attempted rally, which hit that 20-week moving average. And then Thursday night, it got smacked from there, back below the 10-week moving average. this is that point where the selling pressure is there. The weekly trend is down. We've already had one big wave down. So the question is, right, what happens if the selling continues from here? And there is a point when the momentum can really shift. And we know if prices head below the low of the whole correction, that's when you really have to wonder what can happen. So we've just got a few things now adding up saying, well, you really do have to be careful here in the big picture, in the, where the indices are going, where the US indices are going. Our market holding up much better. But if we see a sort of a cascading of selling coming in with the US bonds, if they shoot through 3.2%, if stocks take fright, especially tech stocks, and it crashes through the low of the whole correction, there is just a situation here where the odds are getting higher that we could see a much larger correction dead ahead. So let's just have a look at an example of what's going on in that tech space in the US. And we have Netflix coming out on Thursday. They were already selling off. I mean, look at this, a rally from around 2010 from near zero up to $700 a share, an amazing run without many pullbacks. And this is what's happened just in the last few months. $700 down to $200. This is what happens when rates turn, when you've gone from rates at zero, when people are looking at those future earnings and thinking, oh, those future earnings could be big. I only need to look at the net present value based on very low rates, which means it's still worth a lot of money. And now as rates rise, the future value of those earnings is going down. And also the expectations of just future eternal massive growth forever and ever and ever, everyone pricing things based on that. All of a sudden, growth is actually going negative, and people extrapolate that and say, wow, our valuation, buying things at 10 times their revenue, expecting eternal growth forever, that little game is all of a sudden not looking so good. And all of a sudden a stock that was 700 is 200. And that's the situation we're in. Meta was a similar situation. You can see here, that one coming off the boil incredibly as well. So, in the background in that tech space, there are some pretty scary things going on. Meta going from $375 to 188. And look, it should find support down around here, but may not. So there are a few things really falling out of bed in that space. And I think there could be more to come, especially if rates continue really ratcheting higher. So jumping to the Aussie dollar, and I was saying to you a few weeks ago, looking like it was a bit top heavy. The selling came in where you'd expect it to come in. Here's that huge wave up over the last few years and turned back down. And if it is going to turn down, it's sort of in this sell zone of that wave where I'd expect the selling to come in. And we've had a few attempts at rallying, but turning down again from that space. Just for the moment, the Aussie dollar certainly has lots of tailwinds, but right now, I think there could be further downside. We saw uranium off 10%, a few other things. There's global growth expectations are being ratcheted down. So demand for commodities could be getting ratcheted down as well. So just have to keep an eye on that level of things. But it is sort of a bit of a sign across a few different things, saying the risk appetite is waning a little here. And look, it may only last for a few weeks, a quick sharp sell-off and then turn back up again. All I can see is what is immediately happening and what could be dead ahead. And it's just a little setup here, which I don't see very often. Those US 10 years, certainly keep an eye on those. The S&P 500, it really could start to sell off at a more rapid pace over this next few weeks. So keep an eye on that. And just generally be a little bit careful out there. because it is an interesting setup and an interesting situation, especially as the Fed starts to wind back their support for the market. All right, I think that's quite enough for this week. I will come back with more next week, and please do sign up for the Money Morning free newsletters if you can, and check out my services, which is the Fat Tail Microcap Trader and also Pivot Trader. All right, I'll come back with more next week. Cheers.